Have bonds always gone up when stocks have gone down in the past? Bond investments are considered the best way to offset stock market risk in an investment portfolio. But are they? In this video, we'll see if this has always worked in the past. Hi, my name is Camille Gaines. Welcome to Retire Certain. This channel is all about one, helping people build wealth with slightly alternative methods that don't take decades, and two, creating diversified income streams so you can live well. I am not a financial advisor, so I'm not trying to sell you wealth management services or act as a financial advisor. I'm just a little bit of a nerd around investing. I'm also an accredited financial counselor, but mostly I just share what I've personally learned from investing for almost 40 years and from creating diversified income streams over the past 15 years. So as a disclaimer, do your own research and hire a financial advisor if you feel like you need one. Now, back to bonds and what they have done in relation to the stock market. There are many different kinds of bonds, ranging from highly leveraged, more risky bonds to Treasury bonds. Different types of bonds go up when stocks go down and vice versa. Risky bonds tend to go down when stocks go down because investors want more safety. They become more risk averse during times of economic uncertainty. On the other hand, bonds go up when stocks went down. In 2008, well, the proof is in the pudding, as the saying goes. So we can look to see how bonds performed in the 2008 bear market by looking at iShares ETF called TLT. Now, remember that ETFs represent the broad market or a sector of the market. TLT is an index that represents the 20-year U.S. Treasury bond. So in 2008, TLT was up almost 34%. It is worth pointing out, though, that TLT declined 21.5% in 2009. Now remember, in March of 2009, that's when the bear market ended and the stock market began recovering. So remember, bear markets are usually tied to the economy slowing down, as you've probably seen in some of my other videos here. And the Federal Reserve lowers interest rates when the economy slows in an attempt to get the economy to grow more again. So when interest rates go down, bonds usually rise in value, especially long-term bonds. A core investing principle is that bonds go up when interest rates decline. So just kind of remember that as a you'll want to be aware of. Now this may sound complex, but it's really very, very logical and simple when you think about it, as most investing is, right? Now, do Treasury bonds always go up, though, when stocks go down? That's a really, really important question. If only risk management were this simple, that every single time stocks had gone down in the past, Treasury bonds had gone up. Unfortunately, they haven't. I was researching this and I created a little chart on my website at retirecertain.com to show the years since 1969 in which stocks went down or Treasury bonds went down, to illustrate this point. In 1969, both stocks went down and bonds went down. So this confirms, it's a little disappointing, but it does confirm the reality that U.S. Treasury bonds have not always gone up when stocks have gone down, as is commonly believed. And in 2018, Treasury bonds went down a tiny little 0.02%, while stocks also went down a little over 4%. This is hardly worth mentioning since the Treasury bond decline in 2018 was so tiny, but it did discredit the assumption and the belief that stocks and Treasury bonds are always negatively correlated, or that's the financial lingo, sorry, for stocks or investments that move opposite one another, negatively correlated, which kind of makes sense. They're not correlated, they're negatively correlated. If you want to know more about stock market risk, watch this video next. Build wealth, create income streams, and live well.